The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk about taxes. And I'm going to tell you, here we are. We're on the cusp of August. August, September, October, November, December. That's 5 months before the jig is up. And so we want to get you so that you know what's happening, not what everybody says is happening, but you know on your personal return what's happening in the world of taxes, because that's where a lot of our money goes. And so, again, if you want to join our show, 803-0930, 803-0930, star 930 on a cell phone. And I have my compadres here in studio with me, Tiffany Fabian. Hey, Tiff.
Hey there, Esther. Happy Saturday.
Happy Saturday to you. And Christopher Fabian.
Hello, Esther.
Hello, Christopher. I was watching Seinfeld the other day, and when he says, hello, Newman, you remind me.
And did you say live? We're EG Tax on the radio.
So let's see. What's new in our world? We're trying to find a new corporate headquarters. Not very successful. All the investors have bought up all the property in Erie County, and we cannot find a new main office. And I feel so bad for my poor clients, and you guys know who you are, that have to park in our parking lot. It's just so squishy. And we're trying to buy parking, and there just isn't any. We're thinking about putting a parking garage in. It's very, very much a problem.
I was just going to say we can do one of those new electronic parking garages where the car,
We must live in California or something.
And you're out there. We need about 8,000 square feet, Erie County, good parking, lots of parking.
Well, we could put the parking garage down below our office. Have them dig down below.
Yeah, right. In You deal with the building department, not me. Anyway, let's talk about things that are happening. Again, 803-0930, 803-0930, star 930 on a cell phone. Okay, what's happening? We're getting lots of letters from people that haven't reported the sales of stock, right?
That's the big one right now, that, you owe us all this money. You had unreported income, and it's from stock sales. And they're like, but I didn't sell. And it was their broker repositioned them. That's still a sale. You still have to report it. I had a lady come in yesterday, $33,000 the letter was for. And she was panicking because she's going out of town.
And how much did she really owe?
She's getting back $1,500.
Oh my gosh! You mean to tell me they wanted $33,000 and we're getting her back $1,500?
Yep.
Because that's what happens all the time. If you're getting letters and you don't get a second opinion, and I'm going to tell you, we do second opinions at no charge. You can be, and probably are, overpaying your taxes. So you want to make sure, if you've gotten letters, EG Tax is there for you. Tiff, what's happening in your world?
Well, we have don't forget, if you register for the Buzz seminar, that's October 13th, which is really exciting. We have the financial guys, they're a presenter there. We have Jeff Boron talking about college planning. We have Hayfleck there talking about Social Security. Dennis Kitchen, one of our lawyers, talking about general practice, bankruptcy. Jeff Katz talking about estate planning. He was our guest last week on the radio show. We have Esther talking about tax reform. So register.
Taxes? I don't want to talk about taxes.
Yeah.
No.
October 13th.
The bottom line is, the people that you've listened to and have listened to and
series.
trust. I mean, we want to help you, and there's no charge, and we don't make you promise you're going to come see us. That's not what it's about. We want to make you a wise consumer so that you know what the heck is going on.
And then also, I just want to say that another one of our services that I think we do really good are offers and compromises. So if you hear those commercials where if you have a big, huge debt and you can pay to the IRS or the state of New York, you could pay pennies on the dollar. And that's where you say to the IRS, okay, I owe you $25,000, but I can settle this debt with, for instance, like $2,000. That's what they talk about, pennies on the dollar. And it's a great service. And we do it on the computer and we do it, efficiently. And it's just call to get an opinion because it might be something that you're eligible for.
That's absolutely right.
Yeah.
Okay, and again, if you not only can call in, we got all our calls coming in. You can also text us at 3930 your comments, and we'll answer your texts as well. And it's completely open season. Where our kind of our thought of the day is talk about the things in the tax laws that didn't change. And we'll also kind of throw in the things that did change so you can understand how the things all work together. But we're going to kind of talk about the things that didn't change on the change in the tax law, which has been so dramatic. But we are going to go first to the phones, and we're going to talk to Roz. Hey, Roz, how are you, my dear?
Hi, Esther. I'm one of your clients.
Thank you.
I'm a licensed nurse, and about 4 weeks ago, I started taking care of a patient privately.
Okay.
Long-term care insurance, and I'm not being paid under the table. However, I want to know how much money to set aside for taxes because I don't want to be stopped at the end of the year. Is there like a table or some formula that I could use? How do I go?
Sure, absolutely, no problem. Chris, you want to?
Yep. Now, do you have to buy anything? Do you have to bring supplies?
No.
And how far away is it from your house?
Oh, it's 1 mile away.
Okay.
Okay, so you're going to want to easily keep 30% to the federal and 7% to New York State.
Set it
aside.
Now, do you have another job, Roz? Are you also on a W-2?
Yes, I am. However, the agency that I work for, they have no nursing cases right now. They just have A-level cases, so there's quite a discrepancy in the pay rate. So I decided this happened to just fall into my lap. This gentleman who has long-term care insurance, and he has nurses, who take care of him in his home.
Okay, so here's the thing. Yes. You started when, Roz?
About 1 month ago.
Okay, so what you want to do is prepay your taxes. Chris is absolutely right to set it aside, but I would go further, and I would say come in and we'll either prepare you an estimate so that you can prepay it, or we can mail it to your house. We'll do you an estimate. This way, you'll have a September payment in and a January payment in, and even though there would be no penalty if you owed money, it's always... Don't you think, Chris, that it's always nicer when people don't owe money, that they just kind of are flat even? So we'll do you an estimate and a quarterly payment so you can pay those as you earn them, and it'll make tax time a lot nicer for you.
Yeah, I didn't want it because a friend of mine does it also, and she said, I owe $2,000 at the end of the year, and I said, I don't want to be in that position.
Yeah. So call us on Monday at 632-7886, and we'll get that estimate out to you.
And it's quarterly payments.
It's quarterly payment, one to the federal, one to the state. So it would be, you would have September, you've already missed June, so you have September 15 and January the 15th of next year. It's due next year, but it's actually it's going to be for 2018, and you'll have the money in to the IRS in the state of New York.
Roz, make sure that you keep track of your records, money in and expenses, because your expenses are really going to help to defer some of that, your legitimate expenses, that self-employment tax, your uniforms, your mileage, your cell phone, office supplies.
Like malpractice insurance on your own, that's going to be a deduction. And the other thing is you can do, because you're self-employed, you can set aside money into a pension plan. You could do an SEP, and that'll save you some income taxes as well. But the pension plan contribution, we can actually make that payment next year retroactive to this year and save you money after we do your tax return.
Wonderful. I will call your office.
All right. Thanks, Roz.
Okay, bye-bye.
Bye-bye. Yes,
and,
sir.
what a good year for her to start this, because one of the tax changes is with her self-employment will come at the 20% pass-through deduction,
That's exactly
which
right.
will save her a little bit of money too.
That's exactly right. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. We're going to take a short break, and we'll be back on the other side with Marilyn, Jerry, Kevin, and your calls. Okay, Frank, I give up. Who is that?
Jimmy Eat World.
Jimmy Eat World? EAT? Good.
Yes.
Not Boy Meets World,
No.
No.
but Jimmy
World.
Eats World.
Yes.
Okay. Now that's Frank's theme song here. No, I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. I know we have a text that came in, but I'm going to deal with Marilyn, who's been so patient. Hello, Marilyn. How can we help you, my dear?
Hi, good afternoon, Esther.
Hi. What can we help you with?
2 questions for you. One, I don't know what to do about. I make $11 an hour at a full-time job. I'm a single parent, okay, and I live in a studio, and I don't know what to claim. Should I be claiming 0? Because I've been claiming 2.
Do you have anyone living with you?
Just my son, but
How old is he?
he's 32.
He's 32. Does he work?
No, not right now.
Is he unable to work? Is he disabled?
He's going through a few things right now, so he can't work right now.
Okay, so here's the thing.
Fine. Okay.
If your son is living in your home that you're providing and he is unable to work and he's considered to be totally and permanently disabled, now that would mean that he can't get a job for at least a year. Then your filing status goes from single to head of the household. As a result of that, your standard deduction is going to be $18,000. And so your tax bill is only going to be $400 next year. So, $400. So,
And actually,
she's going to get a $500 credit
right,
too.
so you'll have no
get a $100
taxes.
refund. Right.
So
you
continue
don't owe
to do
anything.
continue to do 2 or 3.
Yeah, because there's this brand new family credit, which your son, if he's unable to work, will benefit you for. So what you need to kind of do right now, you got 5 months before the end of the year, get all your documentation from his doctor. Many times what I found, and I don't know if you guys would agree, that older son really can't work. And I'm not saying that this is your situation, Marilyn, but many times they can't work because they're having a drug problem. And so if that's the case, you want to get the doctor on board with you saying that your son is unable to hold a job for at least a year.
Yeah, or other disabilities.
Right, or other disabilities.
There's lots of
Yeah.
mental, physical,
Right.
But start getting your ducks in a row, I think, is a really good idea.
Okay?
Oh, okay, and then
So don't change your withholdings.
okay, my father has UPS stock, and he wants to leave it to us when he dies, and he's in his 80s and he's a little sick right now. How do you go about doing that without us? Does he leave it in his will?
Leaves. What he would do is he leaves a will right now because the stock is in his name. If he says that Marilyn is my beneficiary and she's getting all my worldly goods, then you'll end up with a stepped-up basis on that stock upon his death. So if whatever it was trading for on the date of his death, that will be your cost basis. So if you sold it, it won't cost you anything.
Okay, the government won't come after us because there's 5 of us kids.
No, because it'll be split evenly and everybody gets a stepped-up basis.
Okay, so in other words, is he better off to sell it before he dies for us, or is it better for...
It's better for you to inherit it. The only fly in the ointment would be in the event that he goes into a nursing home, because that's an asset. And so they could actually take his assets to pay for him as a private pay patient if he gifts it for the first 5 years. So you want to make sure prior to going into a nursing home, if he's going to be gifting away assets, that you understand that money is really not yours until that 5-year period is up, if he should go into long-term care where he'd have to be a private pay patient.
Yeah, I understand that part. I just didn't know whether it was better for him to
It's really better for most people to inherit the asset as opposed to have it gifted. Now, everything depends upon everybody's situation, and it's best to work with your attorney to make sure, but just as a rule of thumb, if parents aren't going into nursing home and there's capital assets, the kids would then get a stepped-up basis, which is good. It'd be the fair market value on the date of the death of the decedent.
Okay.
Okay, Marilyn?
Thank you so much.
Thank you, dear.
Your time. Thanks.
You're welcome. Bye-bye. And it's very important. I mean, this time of year, we really wanted to stress it's important.
Yep.
Tax plan.
Yep.
It's important to do planning all the time. coming up with your own decisions many times is the worst thing you can do.
Yep, and that's why it was really wise of her to ask, should I switch my withholdings? I had a client call the other day, and they're like, okay, I've been noticing I'm getting extra in my paycheck, and I know it's because of the tax reform, and is this going to be a detriment to me? And we ran all the numbers, and she has a few kids under the age of 17, and so she's going to get $2,000 per child, and it was okay.
And that worked out.
It worked out for her.
Worked out. Okay, let's go to Jerry in Buffalo. Hey, Jerry.
Hey, how are you?
Good. What can we do you for?
Well, my situation is this: my mom passed away earlier this year, and after she passed, I received in the mail on her behalf a corrected interest statement for the year 2016 from her bank.
From 2016?
Yes.
Wow.
How much was it? What did it say, Jerry?
It was a corrected amount. The amount reported to the Internal Revenue.
How much?
It was probably, the overpayment was like about $4,000.
So they're saying that the correct...
she over-reported her income on her 2016.
Okay, did you get it from the bank or the IRS?
From the bank.
From the bank.
Yes.
That she over-reported her income.
Yes.
That makes no sense to me. Does that make sense to you,
Well,
Chris?
the bank must have really had a typo on their system then.
You know what you should do, Jerry, is why don't you stop in the office? I don't know what part of town you live in. It says Buffalo. So if stop in our office on Niagara Falls Boulevard, bring that 1099 form. If you got Mom's 2016 tax return?
Yeah. My question is this: can I just file an amended return and stipulate, the correct amount of interest that should have been reported?
Yes, you can, but I guess what I'd like to see is, did she really have to file a return?
In 2016?
Yeah.
Yeah. My question is this: on the amended return, whose name do I put on the 1040X?
You do Mom's. It's Mom's tax return. Then if you're getting a refund, for instance, you do a 1310. It would be a refund due deceased tax from a deceased taxpayer to the beneficiary or the executor of the estate, and then they'll make out the check in your name on her behalf.
And how do I stipulate that on the 1040X?
You do you do it in her name, okay? And then you attach a 1310, and you mark at the top of the tax return that this is a decedent's return. So then they do the 1310, and they'll type the check in your name.
Okay. Okay. If I have difficulty, I certainly.
Yeah, I mean, there's no charge for us to look at it. So if you're stuck between a rock and a hard place, we're right down the street.
Yeah, I live in South Buffalo, so.
Oh, it'd be far up the street. But you know what you could do is, if you got a cell phone, take a picture of it, and just email it to us.
Or I can email. Okay, I can scan it.
Yeah.
Mm-hmm.
Okay.
All right. Okay.
All right. Sorry about your mom. Thank you.
Gonna say,
Thanks for the call.
I was going to say, first thing I would do is call the bank to see why there was such a discrepancy in interest.
Trouble is, I mean, that's probably true, Chris. But you think you're going to talk to somebody?
Well.
That's I mean, I hate calling anywhere.
Yep. Go into the branch
Nobody
and say.
talks to you.
I mean, $4,000 is a big difference. It sounds like bond interest was reported wrong.
What's weird is, how would they say it was over? So they're saying that they gave her $4,000 too much in interest?
Yep. They reported on the original 1099 INT, like we'll say $5,000.
Yeah.
Now we got a corrected one for only $1,000.
That is,
and that's why I'm
really
saying
weird.
I would go to the bank and.
That is really, really weird.
Odd.
But
Yeah.
here's the thing: are you guys successful at getting a hold of people on the phone?
Oh no. And then I've been doing this for 17 or 18 years. I can't tell how many people I've said you need a corrected 1099, and I don't think anybody ever gets a corrected form from the bank or from anyone. It's really difficult.
It is difficult. Well, I mean, the brokerage firms are probably the best.
Right.
Wouldn't you think?
Yep.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And we're going to go to Kevin. Hi, Kev.
Hi, Esther.
What?
This is to my girl, Tiffany.
Hey.
Hey, what's up? Kevin from Jamestown.
Hey, how are you doing, Kev?
Good, Tiff. I just want to say that Esther, I took out some money earlier this year, and I'm a retired worker, and I'm on disability. Worked 30 years, and me and Tiffany figured out we would take 10% out for the government and 3% for the state.
Right.
And then I might have to take a little bit more out. Should I take it this year or wait till next year? Because I'm waiting for some money from I was in an accident.
All right. So are you on Social Security, Kevin?
Yeah, Social Security disability.
And are you a married gentleman?
I'm divorced.
So any children living with you?
No, they're all gone.
All right. So you have only the Social Security, and the money that you're taking out, you're taking it out of your IRA?
Yeah, I took $20,000 out. Me and Tiffany did it earlier.
And how old are you, Kev?
I'm 61.
All right. So his standard deduction is going to be 12.
Yeah, and that's right. Too much
and
for EIC.
So if he's got $20,000 he's taken out, he's going to have $800 liability.
Right.
Well, you got to figure Social Security, taxable Social Security.
And plus, yeah. So
I would wait till next year.
till next year. Yeah, Kev.
We took out 13% when I took the money.
Yep.
Well, I mean, you're going to not owe any money because you had the withholding. But if you take out any more and more of your Social Security is going to be taxable until it's 85% tax.
So Esther's asking if you could wait till January 1 of 2019.
So that you don't have to pay so much money on your Social Security.
Okay, thank you very much. Bye, Tiffany.
Bye,
All right,
Kev. Let me
thanks,
know if you
Kev.
need anything. I hang around there every day.
All right. Thanks, Kevin. I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break for the news. We'll see you on the other side.
Oh, hey, what's up? That must be Weezer. Wow. Thanks, Frank, for the hint. This is EG Tax. We're here to help you. 803-0930, 803-0930, star 930 on your cell phone. Then 3930 to text in your questions, your comments. Would love to hear from you. And speaking of texting in, we got my brother and I have 75 apartment as tenants in common. Can we benefit from the recent tax law changes by creating a corporation or LLC? So the answer is, yeah, maybe.
We were teasing this and tearing it apart up here in the studio, right?
Yep. Because supposedly the pass-throughs do qualify for rental property. So as long as there's a profit on your rental properties, you're actively participating, then you do qualify for the new tax law without going into a corporation or an LLC. But with that being said, a corporation or an LLC would give you the umbrella protection where your personal assets can't be sued, can't be taken from you in the event of a lawsuit. So there's a yin and a yang. And if you're going to be doing an LLC or a corporation, you really want to do maybe 2 or 3 houses in each LLC. So if you have 20 houses, you may end up with 6 different corporations.
And then you got to make sure you get insurance. And if you do an LLC, it costs a lot of money to advertise and do all your due diligence and things like that, you know?
Yes. So you got to really weigh your options. Sometimes it may be just a simple umbrella policy with your insurance company to give you enough protection before you spend all that money.
But really good question. And actually, Chris, if he leaves the rental the way he has it, the 20%, if could be something that's afforded to him anyways.
Correct.
Oh, he's going to get that anyway.
Right. Well, Chris started by saying you'd get the pass-through, but he'd get the pass-through even if he doesn't make it.
Pass-through whether he does the LLC
Right,
or not.
Right, that's what we
Yeah,
said.
right.
Yes,
Right.
Yes. So that's where
That's
we
what
were
I said,
going into
yeah.
the difference between incorporating or not.
I mean, what is your take on it?
Well, I mean, he's going to get. The thing is, you're going to do the LLC, not from the tax standpoint because it's all done the same way. It's all on the Schedule E. You're doing the LLC for protection.
That's
Right?
right.
Right.
That's right.
Yep.
That's right.
Because people love to sue.
Right. Right. Exactly.
No, they don't. What are you talking about?
Right. And especially, in New York State, because New York State is a very litigious state. There's a lot of attorneys hanging around. Buffalo Law School's cranking them out, University of Buffalo. So anyway, so 8030930, 8030930, star 930 on a cell phone. You can text us, and that we thank you for that text, 3930. Love to help you. While we're waiting for our other calls to come in, we want to talk about some of the things everybody's talking about how the tax laws are changing. It's important for people to understand the things that are staying the same.
Yeah,
right?
That's right.
Like, for instance, your wages, your interest, your dividends, your unemployment, your pensions, your Social Security that's taxable over the threshold, and the threshold is staying the same. Your net rental income is staying the same. Your net profit from businesses are done the same way as before. There's a limitation. There's a change on entertainment, farm income, New York State taxable refund if you had itemized the New York State, miscellaneous income, gambling, sale of capital assets, sale of depreciable assets, and debt forgiveness. That's all staying the same. Now, what's going to change on rental income is just like the guy that texted in. Mm-hmm. There's a 20% pass-through now.
Right.
Which is great. So if you make a net profit on your rentals of $10,000, you get a $2,000 deduction, which was never done before.
Right.
The other thing is there's a change on your business. Again, there's a 20% pass-through. Again, if there's a profit.
Correct.
There's a 20% pass-through. Now, here's the thing. They're going to make you net your gains and losses. So it looks like, and nobody knows exactly, because one of the things I was reading the other day is like there's so many things that are like left ambiguous right now, and the IRS is going to be kind of ironing out the wrinkles before the end of the year. But right now, this is what it looks like. If you have a rental loss on this hand and you have a profit on your business on this hand, before you get your pass-through, you're going to have to net the two, and then the pass-through will be on the net positive portion.
Yeah. One of the classes that we took, we sat there in your office, and you taught us that, I mean, as we were doing the class together.
But again, I'm reading what the law says.
Right.
Who knows how, I was listening to a long thing on the internet the other day from one of the major CPA firms, and their head CPA guy was saying there's so much ambiguity. We're really not sure how some of these things are going to wrinkle out.
Yeah, I know. I know. We had a call the other day, speaking of that, about someone who just received a lump sum in Social Security going back to 2015, and part of it was going to repay back disability and the $6,000 lawyer fee. And what's going to happen with the lawyer fee, because that's not deductible anymore.
Where it used to be. And I think in accounting, we like to know all the answers, and you want to have your I's dotted and your T's crossed. However, there's, like Esther said, so much ambiguity, and it just doesn't sit well with us.
They're actually saying that they're going to kind of straighten out some of the double talk, because on one part they put this change in tax law so quickly together that there was, like, on this side of the law they said this, but then they were citing something on this side, and they're not sure which they meant. So when they're going to be talking about the second phase of tax reform, hopefully they're going to straighten out some of this stuff before the end of the year.
You mean like shortening up the tax form, but then adding 6
yeah, and that's one of the things that has changed, is that President Trump did get his postcard, but unfortunately it's 2 sides. So if you add them together, that's one sheet of paper. And now there's 6 building blocks that go to the tax form. So it eliminated a page, but now we have 6 extra building blocks to which you attach the forms that back up but it's just like the Schedule D. Remember the old Schedule D?
Yep.
We just had Schedule D.
Yep.
But now there's another form that has to be
8949.
that then goes to the Schedule D, and it confuses people. Right?
Paperless society.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone.
I just did a letter the other day for somebody who said they owed thousands and thousands of dollars, and that's because they forgot to attach the 8949. So, it's going to be very confusing.
That's right. Okay, let's go back to the phones. And we got Jerry from Buffalo on the phone. Hi, Gerald. How can we help you?
Hello, Esther. I turned 70 and a half January 24th of next year.
Next year?
Next year.
Okay.
Do I have to take my required minimum distribution by?
Well, Chris, you want to
Sure.
give Jerry the the explanation?
Yep. You have actually until April 1st of 2020 before you have to take out your minimum distribution.
But in that year, he'd have to do a double.
Do a double. Yep. Do a double distribution, one for 19 and one for 20.
So if you don't want to do it that way,
then you want to do some tax planning to see what's better for you, to take it one in 19 and then one in 20, or wait to 20. All depends on your other income, your Social Security, anything else that's happening in your life.
All right. So in other words, because you're turning 70.5 in 2019, you can take out the RMD that first year in 2019 if you want, but you can push it off to 2020 in the first quarter and take it out. Then by December 31st on that same year, you can take out a second distribution. So that first year getting started, they kind of say, well, I know maybe you're not really sure of what you want to do, so we're going to let you take the whole year to mull it over. And if you want, in that first quarter of the next year, you can take out that first distribution that should have been for the 2019 year, but you got to take out a second one. So you actually have an option, Jerry. You can do either or.
Really got a plan. I think most of my clients don't wait. They usually take their RMD the years that they should. How about your clients, Chris?
Yep.
Well, the either way is should, right?
You got to either way, because if you don't,
right,
a 50% penalty.
The penalty is 50%.
Right.
Okay, Jerry?
I don't have to take it then January 17th. I can wait maybe to April or May.
You could even wait till December.
You can wait till March the 31st of 2020 if you want.
But then you'd have to take two distributions that year. So really give us a call and we could plan together if you wanted us to.
Okay?
All right, thank you.
All right, thank you, sir. I'm Esther Goulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Okay, so we talked about some of the things staying the same. Here's some other things that are staying the same. Student loan interest is still deductible up to $2,500.
Mm-hmm.
IRA contributions, same.
Right.
Okay. Moving expenses are gone, except if you're in the military and you're moving, and you're in the active military and you're moving for your job.
And I just want to backpedal for a second. The $2,500 for student loans, it's not $2,500 for your wife and $2,500 for the taxpayer. It's $2,500 per return.
That's another,
and that stayed the same.
If you think about it, that's a marriage penalty.
Yeah.
Right?
Yeah.
Because if you were two singles, it'd be $2,500 apiece, right? But if you're
Yep.
married filing a joint return, you get one
that way.
$2,500. It's just like with the change in the tax law for mortgage interest. It's $10,000 per person and $10,000 per couple. So it's actually a big.
Wouldn't want to be a
not mortgage. It's,
wouldn't want to be
property taxes, the SALT deduction.
Wouldn't want to be a proponent of marriage or anything.
Well, I mean, it's just better to be single from a tax standpoint many times, right? Other things that haven't changed is the itemized deductions. Now, obviously, everybody's aware of that doubling of the standard deduction, but the elimination of the personal exemption. But the itemized deductions are still in there. But here's the ones that stayed the same. Medical that exceeds 7.5% of your adjusted gross income. And there's tons of things potentially that are that are deductible: nursing home, prescriptions, health insurance, medical travel,
dental,
glasses, dental,
contacts,
therapy, hospitalization,
nursing.
therapy, all that is still deductible as long as it exceeds 7.5% of your adjusted gross income.
Yep.
All right. Hey, we're going to take a short break. 8030930, 8030930, star 930 on a cell phone. I'm Esther Goulias from EG Tax. And this is WBEN. Okay. All right, Frank. I'm biting. Who is this?
This is Real Big Fish.
Real Big Fish.
Versus those small ones.
And he ran away from the guy that was going to eat him, right? Something. Last guy was something going to eat your face off or something. Okay, Real Big Fish. That was Real Big Fish. That's my favorite band. along with Frank Sinatra. I'm Esther Goliath, the tax lady from EG Tax, 8030930. 8030930 star 930 on the cell phone. I know we got a couple calls coming in, but wanted to also go some of the things that haven't changed now. Property taxes, state withholding, state sales taxes, foreign taxes paid are still deductible, but they're capped at $10,000. And right now, the state of New York is supposed to be coming up with some special way to make that all equitable, but that's the way. That's one of the things that have changed. Mortgage interest is still deductible, and so is home equity credit lines as long as you used them for home improvement. Charity's deductible still. Now, but if you're somebody doing an RMD and you're somebody that likes to give to charity, if you pre-plan and you take your RMD from wherever your financial situation is and roll it over directly to the charity, that fulfills your RMD requirement and it'll probably save you some money on taxability of Social Security.
Pretty cool.
Right? And casualties now deductible as long as it's a federally declared disaster area, and so are miscellaneous itemized deductions, but not the ones subject to 2%. So you can't take You can't take job hunting, job expenses,
licensure, continuing education,
right?
Your cell phone, office and home,
attorneys, tax prep,
brokers.
Yes, your stock brokerage, investment expenses are all kaput. So those are some of the other things. Okay, let's go. We got.
If I sell a piece of property, do I have to pay? This is a text call. If I sell a piece of property, do I have to pay tax on the money that I gift help?
It says the money I get.
Well, GIT, yeah.
Not gift. I think they mean get.
Yeah.
Yeah. If you sell any capital asset, all right, then it's potentially a taxable event. So you have to report it on the Schedule D.
Unless it's a personal residence, yep. But it doesn't say that.
Right. But if it's a capital asset. And so then you kind of compare what you paid for the house plus all the improvements from what you sold it for less the expense of sale. And the difference is going to be a potential taxable event, which may be at 0%. Right, Chris?
That's right. Depending what tax bracket you're in. If your income's low enough, you could qualify for the 0%. That doesn't mean New York State. New York State will still want their share of the pie.
That's right. Just like Mike and Glenn said, the state is very good at managing your money. All right, let's go back to the phones. And we got Mike from Grand Island. Hi, Michael. How can we help you?
Thanks for taking my call.
Yeah.
My mother recently passed. My brother inherited. He's 65 and he's on Social Security disability. He's inherited part of a taxable annuity.
Mm-hmm.
Will that affect his Social Security at all?
No, it won't affect his Social Security. First of all, he's almost at normal retirement age. It would affect it if he were to have gone back to work, because if you're on a disability, then you are basically saying to Social Security you're unable to work. So if he had gone back to work, that would be something that he'd want to share with Social Security, because they do actually have a phase-in program for people that were on disability who are trying to get back into the workplace, and they usually give you like 6 months and a dollar figure before you'd actually be eliminated from your Social Security disability. But in this case, he's inherited an annuity. So even though it won't affect him getting the Social Security, it may affect the taxability of the Social Security. Do you know how much he's going to be getting?
It's like $7,000
a year or a month.
It'll be just
a total.
Yeah, then it's not even going to be taxable. It won't affect him at all.
Okay. Does he have to report that? Or?
Not really. Not if he's under $12,000.
Unless he has other pensions or annuities or IRAs.
Yeah, he won't have to.
He only gets like $900 a month. So.
No. Yeah, no, he'll be fine.
Okay. And then as the executor, do I have to file a return for my mother?
It all depends. When did Mom pass?
June.
So for the first 6 months of the year, did she have any form of income?
Pension, part of a pension from my father, Social Security, and that's about it.
All right. So on Dad's pension, was she having any withholding?
No withholding.
And so how much was the pension per month that she had gotten?
Probably 600 or so.
No, then you will be under minimum filing requirements for your mom as well.
Okay, so I don't have to file a return.
That's correct.
Well, you might have to file
all right,
a return.
Now,
for
all right, let me put this caveat in there. In the event that you sell any, of course, those would be on the trust. So if you sell any of her assets, like her house or stocks or things of that nature, after her death, you might have to do a trust return for a fiduciary return.
No, she had no stocks or anything. But
no home?
Well, the home will not be sold because...
It's going to your brother, right?
Yeah, he has to have a place to live.
Okay. All right. So it'll be fine. But just to be sure, just before the end of the year or first part of the year, give us a call and we'll go over everything with you over the phone to make sure that is the situation and nothing has changed.
Okay, I'll do that.
Okay?
Yep.
Sorry about your mom.
Yep.
Okay, thank you.
All right. I'm Esther Golias, the tax lady from EG Tax. 8030930.
Oh, Chris is saying
yes,
something.
What do you
know, one thing
yes,
I
sir.
just thought of
Yep.
is depending how long his brother's been on Social Security, is his insurance Medicare or is it Medicaid? Because that annuity could throw him out of Medicaid for 1 year. So he's better check with the insurance company to make sure his brother is still covered with health insurance.
Okay, so that is true. With the complexity of the health insurance, that would be a fly that possibly could get in the ointment. It's not a tax issue so much as it is a health insurance issue.
But he's close to Medicare.
He's close to it, but that's where he got it with that $7,000 though could kick him into the essential plan,
right? Which would be $20 a month.
Yep.
Right, but again, it would change his form of insurance.
Yes.
And his payment.
Yeah.
Okay. Some of the other things that haven't changed is the child tax credit is still there, but the child tax credit has increased.
Yep.
That's right.
Up to $2,000 per child under the age of 17.
And refundable up to $1,400.
Right. And the education credit has not changed. So the American Opportunity Tax Credit is still in effect, all right, for the first 4 years of continuing education.
And then another thing, sorry, about the child tax credit is that it used to go away when start phasing out when a married filing joint returns income was about a 125.
But this is very good news because it's $400,000.
It's $400,000 for so many of my clients. That's going to be really good news.
That's right.
So it's not phasing out, which is just really
great.
But
here's something: if you're in the process of getting a divorce, the parent who is able to claim the child, and there's some of that non-custodial parent kind of stuff is coming down the pike too. They're talking about changing that. That child is worth $2,000, not $1,000, but $2,000. So when you're doing your negotiations, remember, if you give the non-custodial parent the right to claim the child, they save $2,000 in taxes. So, be careful when you're making those plans.
That's a really good point.
Speaking of divorce, one of the other big switches is alimony starting in 2019 for new divorces are not deductible for the person paying and doesn't count as income for the person receiving it.
Right. And so, and there's now a lot of wonder, consternation. They're saying about any changed divorce decree. Does that mean that if your divorce decree was entered into in 2017 and you're paying alimony, but then they take you back to court and it's been modified, does that mean that would no longer be taxable to the recipient and deductible to the payee? Those are some of the things that are being tossed around right now that have to be clarified by the IRS when they're writing their regs. Another thing that hasn't changed is the energy credit, not for homes, but for certain, like the Tesla vehicle. Those are still in effect.
But next year, the Tesla goes to half.
Goes to half, right.
So from $7,500 down to $3,750.
The credit for it, for the electric vehicle.
And I know, I believe
Tesla.
it or not, I think a lot of people think out there when we say this statement, we just had somebody, but we normally do when we say that. I did just have someone call in and say, I'm thinking of buying a Tesla. What type of credit do I get? I'm thinking of next year. I said, well, if I were you, I would buy it this year to get the full $7,500.
But the unfortunate thing is they're
on
so
back
far,
order.
They're so far behind.
Yeah.
They can't really
they're on
buy
back
it.
order. And so,
and really, would you buy a car that they really can't? I mean,
promise?
It sounds so bad, like the company's half in the tank.
Like,
I mean, would
well,
you
we
really
might
go spend all that kind of money on a car just for a $7,500 credit? I don't know.
Yeah.
Okay, so but some of the other changes, obviously, there's still tax rates, but the tax rates are dropping and have dropped, but not on the computation of the Schedule Ds. Correct, Chris?
Correct. That's
So the
still staying
Schedule Ds
15.
are just taxed like they always were.
15%.
Right. So that's one of the things that haven't changed. And then, of course, one of the big changes is the pass-through deduction. And that's why if you have rental property, small business, if you're in a real estate investment trust, you need to give us a call so we can tax plan with you. There's no charge, but you need to know how the pass-through is going to affect you. And especially if you've been getting extra money in your paycheck, like Tiff was saying at the beginning of the show, you want to make sure that the extra money that you've gotten is going to be correct.
Not have you
I
fall
mean,
short.
maybe you had children turning 17 this year, and unfortunately, your tax bill may go up. So until next week, I'm Esther Goulias, the
Did you
tax
want to
lady.
say something?
Oh, yeah,
I was
Chris.
going to say, for 2018, you still have to have health insurance. If you don't, you still get penalized.
Good
2019 starts where if you won't get penalized for not having health insurance.
So a lot of people
That
think
stayed the
that there
same.
is no penalty, but the penalty stops in the tax year 19, not 18, and we're in 18, right? Okay, well, if you need help, egtax.com is your website where you want to go. During the week, we're there 9 to 5, Monday through Friday at EG Tax. If you need us, 632-7886. Go to our website. We want to help. Have a great week. I love you guys. Bye-bye.